All right, ready to roll. Welcome to another episode of Badass Banking. I think I'm recording right now. Yes, I am. Today I'm with Mike Branton from StrategyCorps. He is a partner there, somebody I have had the pleasure of working with. Super smart guy, located down in the Raleigh-Durham area. I've also got Gregg Early today. He's always early. That's why they call him Gregg Early. He's over in Charlottesville, and he's the director of market engagement here at Moven. And I'm the chief strategy officer and the chief revenue officer of Moven. And I do this badass banking thing just for kicks. So let's turn it over to Mike. So Mike, tell us a little about StrategyCorps and how it fits into the overall banking and fintech space.
Yeah, so good to see you again, Brian, Greg. StrategyCorps, we've been around since 2001, and we're positioned really as kind of the go-to resource for all things retail checking. And what that means more specifically for bankers is we offer a couple of solutions that revolve around the retail checking product and strategy. One is an analytical solution that takes a look at the financial performance and essentially the banking behaviors of every single customer or member in the checking account portfolio. And we call that analytical tool Checking Score, because what we're doing is we're really just kind of scoring the relationship that the consumer has with the FI based on the activities that they have with the FI and revenue that it generates. And so we use that analytical to be kind of the fully informed empirical foundation to get into our other solution that we call Bazing, which is a mobile rewards solution that it can be white labeled, customizable. The analytics helps us to figure out how to use our mobile reward solution in product design, product pricing. So that's kind of how we on the banking side. On the fintech side, as I mentioned, we've been around for 20 years. So we're not a 20-year-old fintech, but as the markets have evolved, so has the company. So, we've entered fintech space essentially from a technological standpoint with our Bazing solution and our analytical solution, Checking Score. Probably the biggest difference between StrategyCorps is we have a stable revenue base because of our recurring revenue model. And we've been profitable since before fintechs that was even invented. So,
you guys have over 350 clients already, right?
Yeah. We do of all different sizes and flavors, from $100 on the small end to 50+ billion at the top end. And so our sweet spot is really the community as we define it, 500 million to about $10 billion in assets.
So I saw this year, especially, I know there was a report y'all did with Ron Shevlin and Cornerstone Advisors this year that was talking about the revenue recession in banking. And I know that recession has been one of those things that a lot of people have been talking about on a broader economic perspective. But as far as revenue recession in banking, what was it that you all were speaking about specifically?
Yeah, so from the pandemic going forward, times have never been better to be a bank or a credit union in terms of financial performance, and so clearly there's been a lot of volatility there, but it's come out on the good side for most banks and credit unions. But there are a few things, as the white paper that you mentioned with Cornerstone states, that are out there that I think that are really market drivers. Number one, there was the net interest margin compression, and while we're in a rising environment, I think at least our discussions with bankers is the cost of deposits, because of the digital nature of the deposit products, is adjusting much more quickly than it has. So that spread or that lag from the spread of rising rates combined with questionable quality loan demand isn't giving them the earnings boost or the revenue boost that they thought it was. I think that mortgage originations took care of a lot of fee income needs, and as we all know, originally are down in a rising rate environment, and you've got the housing piece of that as well. Most community FIs kind of sold out their fee revenue sources to try to get to the overdraft gravy train. And as we all know, there's a lot of market pressure on overdraft fees, as well as some regulatory pressures, mainly by press conferences or press releases at this point. But it's in the eye of the CFPB. So there's a lot of pressure on the overdraft revenue source, and if you read the numbers in that the experts are putting out there in terms of how much revenue that is, while it's a big number, it's actually very understated. It's much more than the numbers you see for out there in the press for most FIs. And then the whole interchange source of income is under pressure. Alternative payment sources, just competitive pressures, and now there's some legislation about the credit card. So there's all kinds of pressures there in fee pressures, in addition to some of the the loan pressures. So what we're seeing is it's setting up for a much more challenging go forward environment for banks. I don't know that we are where Jamie is in terms of the outlook of a genuine downturn and a prolonged recession, but there are some headwinds that are going to require bankers to differently. I don't want to say they can just mail it in or that they were mailing it in, but they've got to be on their toes here, knowing that these traditional revenue sources from their traditional services are under pressure.
Well, that's kind of the thing that it seems with, like, especially community banks and credit unions, is that they have enough going on day to day, and then you add with the challenges you were talking about, just sort of managing those, and then you have on top of it all the non-banks and neobanks that are moving into the sector, and then they have a pressure on that. But generally, these folks are pretty conservative, so they don't really see the solution as dropping a couple million into some whiz-bang fintech stuff. So how do they move from the traditional banking model to a technology or digital banking model successfully with as sort of natives of the traditional model? Is there a transitional resource available at that point?
Well, I think for the smaller FIs, realistically speaking, their idea of being an industry leader is really not practical. So, a lot of stuff that's going on out there from the mega banks and the digital banks are kind of leading the way. The smaller community banks are never going to outspend them or outinvest them in the technology space. So what we see from our client base that are in this smaller community size compete successfully doing is they take as much of the budget that they can to stay relevant from a technology standpoint and a user experience standpoint. And a lot of them are actually tied to the cores, and we all know that the cores aren't the best in terms of, say, maybe their mobile banking or their online banking platforms, but they really don't have the time or energy or resources to go out and maybe connect with a more cutting edge company, but they just need to keep up on that. I think that from a marketing perspective, they're not going to outmarket these companies either. And so, marketing budgets are the first, thing to get cut during tightening times, because most executives think it's a discretionary expense anyway. So I also think that community banks, rightly or wrongly, allocate a lot of their marketing budget to what I call soft marketing or branding instead of product-based marketing. In today's consumer, they check out products online to really kind of assess what a bank is and is all about. It's great that you've been in business for 125 years, but you better have a stinking good product for me to want to buy it from you. So I think that is the opportunity, Greg, for these smaller FIs is to go out and featureize their products, make them a little bit different, make them something that's unexpected to the consumer that they can get in a checking account. Because to date, the digital banks have done that. I'll give you a quick example: is the early pay, where you can get your paycheck a couple of days early. Folks like Chime went out there and they marketed the bejesus out of us. And when I talk to our community bank clients, the response is, "Yeah, we could have done that."
But they didn't.
They just didn't.
Yeah.
So it's that kind of just product featurization that I think provides the opportunities for these smaller FIs to compete with the megas and the digitals, who are clearly winning the account acquisition game, and they're clearly winning the primacy game. So just what we say at StrategyCorps is, hey, just make your products better. You're going to see, downstream positive impacts of that in a lot of different areas. And then, related to that is, try to get yourself into more of a fintech type of subscription pricing model possibility.
Yeah, I mean, the subscription economy is here. You might as well leverage it. The conditioning is already occurring. You mentioned the whole digital, the neobanks, and they're kind of reinventing banking and changing their product mix a little bit, kind of changing the mindset of what a checking account is or a savings account is. I've been thinking about, at Moven, the two recent clients we signed. Most recently, we signed Fidelity Bank in Louisiana. And I know we're bringing you guys into a conversation there because they want to look at the entire product suite differently. It's a neobank opportunity that traditional bank is bringing to market. B1 Bank in Louisiana is doing the same thing. They're going to create a neobank experience to get new market share, but they're going to sweeten their checking offers. So they're going to be looking to offer, products like yours. They want to tie rewards to it, rewards that yield tangible financial wellness, cell phone protection. When I bust my phone, my bank can stand in and save my butt for a lot less money than what Verizon charges. Verizon's $10.99 a month right now. And fundamentally, the coverage is the same that I can get through you guys. The other one is the roadside assistance, the Bill Shark kind of product where I can unsubscribe. Checking is very much alive, and bringing your rewards to that checking environment, I think, are a good way to differentiate. That's another thing that I think financial institutions need to do in time of recession, is find these great opportunities to enhance their products. I couldn't agree more, by the way, on the subject of branding and those soft dollars versus like putting it into where the real ROI is, and that is selling your product. You do that by telling a better story and enhancing the products that you currently offer. But let's talk for checking for a minute. Checking remains the lifeblood of the small financial institution. And I've heard some people say, quote unquote, checking is dead. My son says checking is stupid, but he continues to have to use it, right? It's where the money comes in through direct deposit with his paycheck, and it's the account by which he pays his bills. Regardless of what you call it, it's still going to be kind of the hub of the financial experience. But what advice do you give to the current banker out there who's trying to figure out a better way to increase checking account penetration, or even prevent people from leaving their bank and going to the neos like Revolut or Chime?
Yeah, I think we all kind of get wrapped up around what are you going to call it, and checking is a legacy name, and no one writes checks anymore for the most part. But from our vantage point, Brian, what we say is it's just been redefined, and it's broader than before. I mean, it's payments, it's debit cards, it's online banking, it's mobile banking. I mean, you're not going to have those products and services unless you have a checking account for the most part. So it's really just a broadening and a redefining of that definition. I do think it's still a hub account. I mentioned our checking score product solution. When we look at the analytics there, and we look at the relationship, where the relationship dollars are, where the revenue is, it's all from the checking account relationship. The checking account product relationship is the beginning of the overall relationship. So I think that back to your earlier thing about what can, in particular, community FIs do about the product is, just try to figure out how you can define what a checking account is beyond how the industry defines it. And so it's the things that you mentioned that we include in our mobile rewards platform. We look at our rewards, inventory of benefits, and we say, look, if it's something that consumers are already paying for at another third party, your Verizon example, that we can use our purchasing power to get it at a lower cost and bundle it into a checking account. It can be delivered on a digital platform, and it either protects the consumer of things that are important every day, like the cell phone or the roadside assistance or someone's credit score, or it helps them save money when they otherwise spend it. Like we have the largest private local merchant discount network. So, hey, if I can save a few bucks when I spend it on my dry cleaning or the Jiffy Lube or, getting a sandwich at my favorite sandwich spot, that's as good as saving money, as good as making money from interest. So, our ability to combine all those and be kind of either the financial first, allow our clients to be the financial first responder in these lifestyle events. That's another definition of a checking account that you kind of have to take your banker's hat off and put your consumer hat on to do. Much like again, some of the digital banks, they kind of took the neobanks, they took their banker's hat off, they put their consumer hat on, they looked around, they saw what they could do, and they were like, hey, we can reframe this service in consumer terms and you get a product advantage.
Yeah, I mean, it seems, and we've talked about that too, is with the subscription based, the more electronic your transactions can be, when you can pay for something on a monthly basis, electronically with a debit, that subscription revenue takes less of a chunk out than it does when, people have been used to paying for things in annual subscriptions or even semi-annual subscriptions. So it seems like that, the fintechs, the one thing that they've done is sort of really upend the model and be consumer driven on the front end. And that sort of challenged banks to reevaluate how they perceive their relationship with their customers. And digital makes it even more challenging from that standpoint. But, you also have success stories. And, I think one of those has been embedded finance, which we hear about all the time. And, we see it successfully with Amazon and Google and Apple and a number of different companies out there that are sort of creating these almost financial services structures within the context of consumer products. But the one interesting thing in your report was the delineation between embedded finance and embedded fintech. And I was hoping you might be able to explain that a little bit deeper for us to get a clearer picture of what you're talking about.
Yeah. So from our vantage point, in the embedded finance piece is exactly what it is. It's an embedded financial part of a transaction that the consumer doesn't know about. So you're not sending them to a third party. So think about PayPal. They link to your bank account. Well, all of a sudden to the consumer, well, that's my PayPal account. They forget about the bank account that it's linked to. Uber is another example on typically the credit card side. That you put in your credit card, it's linked to your Uber account. You never even look at your credit card, who the issuer is. It's just, hey, that's who I've got my card linked to. And then probably the most popular one that you hear these days are the buy now, pay later, companies where I'm at the point of sale on a transaction online, and boom, an offer comes up, 4 easy installments of $25, and all I'm doing is literally clicking a box, and it's taken care of. So that's the embedded finance piece. The embedded fintech piece is it still has the concept of being embedded, but instead of it being transactional based, it's really benefit based. So I'll just talk about it in our terms. All the benefits that we were talking about earlier, embedding them into a checking account product, so that Brian doesn't have to go to Verizon to get his cell phone insurance. Greg, you don't have to go to AAA to get your roadside assistance. I don't have to go to LifeLock to get my identity theft protection. It's all, housed in a checking account at a reasonable price. And the beauty of that model is, and it doesn't just have to be non-traditional benefits, by the way. Acorns takes and bundles kind of all in one checking account, some traditional services like retirement plans and investment plans and savings plans. All of it is a means to an end, and the means to the end is it brings in that subscription model in a much more natural, consumer friendly way than traditional pricing models at FIs, which are pretty much penalty based in the checking account space. And so, if you do that, I think a bank or a credit union, particularly a community one, has a much better chance of chasing and securing that elusive subscription customer or member. To date, subscription plans have really gotten to every major industry except for the banking industry. And I think the reason why it's twofold. Number one is it's just not a model that's out there in a prevalent enough way. But secondly, it's just the banking community has not embraced the subscription model because they have legacy pricing models, again typically penal, that they don't understand. How they're scared to get away from that. Number one, it's changed, but number two is they don't really understand how that works against them in the consumer's mind. And then you've still got the consumer perception of it's not totally clear on exactly what I'm going to get charged and when I'm charged and if I'm going to get charged. So the transparency of the subscription model is something that consumers like. And then I think the next thing on the subscription model that it's hard for a typical banker to understand is the subscription model is a payment to have access to these benefits whenever you want to, however you want to. And so that's what the consumer is willing to pay for. That's why Amazon Prime, I'm an Amazon Prime member along with about 130 million other people. And I get to use Amazon Prime when I want to and how I want to. But as long as it meets the threshold question of, is it worth it? I'll continue to pay it. Sometimes I'll use Amazon for a month. Sometimes I may not use it. Same thing with Spotify and Netflix and those kind of things. So, understanding the true basis of the subscription model in our world, in a checking product, it's such a departure from the traditional pricing models. Usually takes a few conversations with a banker for them to get it before they go, aha. And then clearly there's the financial impact of having that stable, predictable, recurring revenue that can help diversify their reliance on transaction-based revenue. And, for us, I'll do a little plug. When you roll all that together, the recurring revenue piece of it, the customer or the member tends to be more engaged when they have this product. So they're using their debit card more, they're more prone to accept cross-sell offers, the NSF just a little bit more. When you roll all that together, a real easy metric for a banker to understand the financial impact is, for every $1 billion worth of assets, we generate about $500,000 in new recurring fee revenue. And that's from the subscription model as well as the downstream effects of more engagement. And so one of the things that we're spending a lot of time on these days on the analytical side is working with our clients on what's the replacement revenue number if overdrafts continue to get, constricted. And a lot of times that $500,000 per billion of new revenue, it doesn't totally replace the revenue that needs to be found, but it's a good running start. So for us, we're seeing a lot more open-mindedness to it, but I think it's probably more financially driven than, say, pricing or product creativity.
Mm-hmm. So the moral of the story is checking doesn't have to be boring. Checking can be something that can be used to differentiate a brand. It's a way to make a product a lot sexier, a product that we use every day, whether you call it checking, share draft, or, your prime account. It's something that everybody's using day in and day out. Why not add value to it while having the opportunity to generate more revenue? 500,000 per billion in assets is not a small number. That's a significant number. It's a number that does not exist for most FIs today. You're saying you can add that additional revenue. And that's probably not including the fact that you're creating those stronger, stickier relationships. So the average household relationship value is going up in value as well. I'm going to include a link to the story, to the Ron Shevlin Cornerstone study, if that's okay with you.
Yep.
And for those of the people listening on Spotify, it'll be below in the description as well. Any last comments, Mike, before we cut this off?
Yeah, I would say just one thing is, something that the mega banks have figured out, and the digital banks not so much, but they're getting there, is, checking is the hub product, and it can be profitable, and it can be sticky and engaging if you just invest in the product and have the pricing right. That's not earth shattering, but it doesn't have to be a loss leader, and it doesn't have to be boring.
Couldn't say that better than that. Well, listen, I appreciate your time today, Mike and Greg. And what I'll do is I'll get this published as soon as possible. And for those of you watching or listening, like, subscribe, comment, whatever you want to do. Thanks a lot, guys. Appreciate your time today.
Thank
Thanks,
you.
Brian. Thanks, Greg.
Thanks.